Welcome back to the deep dive. Today, we're digging into a really interesting story. Nebius Group N.V, that's ticker NBIS. This isn't just some minor shift. It's a company basically reborn, laser-focused on the AI infrastructure boom.
It really is fascinating. I mean, this entity emerged from the whole Yandex situation, that huge corporate restructuring. So our mission today is really about one big question. Can Nebius, which has this deep history but is kind of a new player now, build a competitive advantage, a real moat against the absolute giants like Amazon, Microsoft, Google in this AI cloud space?
Yeah, it's a high-stakes game, and just so you know, all our info comes from the stock research protocol, Nebius Group, and it's fresh, current as of today, October 16th, 2025. This dive is really your shortcut to understanding their play here.
And let's set the stage financially. Right now, the share price is sitting at $123.82. What we're going to do is see where that price fits within our estimated intrinsic value range. We have it at $110 to $145 per share. We'll unpack what that means for the potential risks and rewards later on.
Okay, let's get right into it, laying the groundwork first.
All right. Chapter 1, Business Analysis.
So the first thing that jumps out, for me anyway, is the business model. They're vertically integrated, aren't they? Controlling everything from the actual data centers right up to their own cloud software.
That's spot on. They call themselves a specialized neocloud provider. And their main moneymaker is providing these AI-focused cloud services. They package it as Inference-as-a-Service. Just to clarify that for you, training AI is one part, very compute heavy, but running those trained models, doing the inference, that's where analysts think the bulk of the spending is going. Nebius is really aimed at that deployment side.
Okay, deployment. And they've got two main ways you can use them, right? There's the AI cloud, IaaS. That's infrastructure as a service, like the heavy lifting part, getting access to big GPU clusters for serious compute power.
Exactly. And then there's the AI Studio, PaaS. That's platform as a service. Think of it as, well, more user-friendly. They offer ready-to-use open-source models, and the pricing seems really competitive, like price per token. It lowers the barrier for maybe smaller companies to get into AI.
Now, let's talk scale, because this is where it gets kind of mind-blowing. They're shooting for 220 megawatts of power by the end of this year, 2025. But that's just the start. The big target is over 1 gigawatt 1 GW by 2026. That's an incredibly fast build-out, requires a ton of capital.
It absolutely does. And, that kind of ambition really has to be built on some solid competitive advantages, things the big guys can't just copy overnight. The first pillar is their human capital. They basically inherited this core group of engineers from Yandex. These folks have been building and scaling massive hyperscale infrastructure for decades. You can't just, hire that kind of experience easily.
Right, that institutional knowledge. And number two, the strategic shield. That huge Microsoft deal, the $17.4 billion one, that's more than just revenue, isn't it? It's like a massive stamp of approval from a major player. It seriously de-risks their whole expansion plan, you could argue.
It's a massive validator, yeah.
Yeah.
And the third piece is their supply chain access. Their relationship with NVIDIA is key. NVIDIA isn't just their main supplier for those crucial GPUs. They're also a direct investor in Nebius. In a world where everyone's scrambling for chips, having that kind of preferred access, well, that's probably one of the strongest advantages you could have right now.
And focusing on inference seems smart, looking at the market forecasts, the whole AI infrastructure market expected to double nearly $200 billion by 2030. But the crucial bit is that inference part, Nebius' sweet spot, is projected to be like 2/3 of that market by 2027. So they're positioned right where the growth is headed.
Makes sense strategically.
Yeah.
Okay, let's shift gears. Chapter 2, Management Evaluation.
You really can't talk about Nebius without talking about Arkady Veloz, the founder. I mean, he built Yandex into a $30 billion company. But maybe the biggest test was navigating that post-2022 crisis, pulling off that $5.2 billion exit from Russia, and then pivoting the remaining international parts into this new AI company. That takes some serious leadership skill.
Absolutely. And the whole investment thesis seems to hinge on his focus since then, which has been, well, singular. Plow every single available bit of capital back into the core AI business, chasing that gigawatt target.
And you see that really clearly in how they've raised money. Billions earmarked specifically for data centers, for hardware. But maybe the most telling thing for me was the capital allocation decision around buybacks. The board actually canceled a previously approved share buyback program. They explicitly said, nope, we're not buying back stock, we're investing in growth.
That's a powerful signal, isn't it? It screams long-term value creation over, short-term stock price boosts. They clearly believe the return on building more AI capacity is higher than just buying back shares. That takes guts.
It does, but let's push back a bit. That conviction has a current cost. Right now, their return on invested capital, the ROIC, is negative, around minus 9.7%. And you mentioned the capital needed. Their CapEx budget for this year alone is roughly $2 billion. How long can they keep burning cash like that, even if it's intentional, before the market gets jittery?
That's the perfect lead into Chapter 3, financial analysis.
Yeah.
Because you're right, the current lack of profit is deliberate, it's part of the plan, but you have to look at the top line. The growth is just explosive. Revenue shot up 462% from 23 to 24. And Q2 of this year, 2025, the year-over-year growth actually accelerated somewhere between 625% and 770%.
That's staggering growth, and management clearly expects it to continue. They've raised their forecast for the end-of-year annualized run rate, ARR, to somewhere between $900 million and $1.1 billion.
But yeah, back to your point about cash flow, free cash flow is deeply negative. On a trailing 12-month basis, they've burned through over $2.1 billion. That's the direct result of that huge $2 billion CapEx plan we talked about. So while their gross margins are actually pretty healthy, 53% to 55% range, the operating margins are way down because of all the investment in sales, R&D, building out everything.
Okay, so massive cash burn. Makes you think about stability.
Right.
But then you look at the balance sheet. It really is a fortress. They've got more cash than a net cash position. And their short-term liquidity, that current ratio, is 14.7.
Yeah, 14.7 is incredibly high. Basically means they have almost $15 in current assets for every dollar of current liabilities. That financial strength is like a strategic weapon. It lets them make these huge multi-billion-dollar commitments for hardware, absorb the operating losses without constantly needing to go back to the market for more cash, potentially on bad terms.
Which brings us to the valuation puzzle. Because they're growing so fast, old metrics like trailing price to sales are kind of useless. It's over 120. Even looking forward, the 12-month forward PS is still high, around 20.42. That tells you the market is baking in a lot of future success already, demanding perfection almost.
It definitely is. So to try and get a handle on it, we ran an educational discounted cash flow model in the DCF, forecasting future cash flows, discounting them back. But given the huge execution risks here and how volatile the stock is, it has a beta of 3.45, which is really high, meaning and it moves way more than the market we had to use a pretty aggressive discount rate, between 12% and 14%.
Okay, high discount rate reflecting high risk. So what did the model spit out? What's the intrinsic value range?
Based on that model, the estimated intrinsic value for Nebius shares comes in between $110 and $145 per share.
All right, that's the key number range we need, $110 to $145. Before we get into how the market feels about that, let's just take a quick pause. Hope you're finding this deep dive useful. Quick reminder to like and subscribe to Stock Analytics AI. For just $4.99 a month, you get access to our whole library, 500 deep dive videos on all the S&P 500 stocks. And coming up next, just for members, we're tackling the NASDAQ 100. Okay, let's get back to it. Moving into part 2, market context.
Starting with Chapter 4, market sentiment. So Wall Street analysts, overwhelmingly positive. You see strong buy or buy ratings pretty much across the board. Average price targets seem to be clustering around $133 to $150.
But look at the range of those targets. It goes from as low as $70 all the way up to $216. That spread tells me analysts are, frankly, guessing a bit. They're struggling to model this kind of hyper-growth accurately. It seems like they're playing catch-up to the story.
And that leads to this interesting paradox. Despite all the bullish analyst ratings, Nebius is definitely a battleground stock. The short interest is really quite high, 11.41% of the public float. That means a significant chunk of money is betting against the stock, thinking the valuation's gone too far. It creates this real tug of war, which partly explains the strong momentum, but also the high volatility we see. The stock's trading way above its moving averages.
Interesting dynamic. So who actually owns the shares? Let's look at Chapter 5, ownership structure.
Well, it's heavily owned by institutions, big asset managers, but maybe more importantly, their strategic partners are also shareholders. We mentioned NVIDIA as an investor. Also, the big VC firm Excel is a major holder, and one of their partners is actually on the Nebius board now. That's pretty strong validation and brings useful expertise.
And what about the insiders? Management alignment.
Looks very strong. CEO Arkady Veloz himself holds a huge personal stake. Economic interest is around 12–13%, worth nearly $4 billion. And crucially, over the last 12 months, there have been 0 open market sales or purchases by insiders. They're holding tight, which signals a lot of confidence, you'd think.
Okay, confidence, big stake. But there's also the control aspect, right? The share structure.
Yes, the dual-class share structure. This is really important. The pre-IPO shareholders, directors, officers, they control 65.3% of the voting power. and Veloz alone controls 55% of the votes. This goes back to that strategic shield idea. It gives management, especially Veloz, the power to execute this really long-term, capital-heavy strategy without worrying too much about short-term pressures from shareholders demanding profits now or maybe pushing for a sale.
So that control is definitely an advantage for getting the plan executed, but isn't it also a potential risk down the line? If the CEO has that much control and things don't go according to plan, who holds them accountable? Is there enough check and balance there?
That's exactly the flip side, the potential hidden risk. And it's a good transition into Chapter 6, risk assessment. Internally, the biggest risk is just the sheer execution challenge. Building out a gigawatt of data center capacity globally, on time, on budget, that's a monumental task. Any major hiccup, delays, cost overruns, that could really hurt them and maybe force them to raise more money, diluting existing shareholders. And of course, the high cash burn rate remains a risk until they turn profitable.
And then there are the external threats. Competition is fierce. They're up against AWS, Azure, Google Cloud, the big three hyperscalers who have, almost unlimited resources and existing customer bases. Plus, that dependence on NVIDIA is a huge factor. If anything disrupts that supply of GPUs, well, their whole growth engine stalls.
Definitely. And we can't ignore the potential geopolitical and regulatory headwinds either. You're seeing more pushback against data centers in some places because they use so much electricity and water. Bans, moratoriums, that could slow down expansion. And then there are hypothetical risks, like what if the U.S. put tariffs on tech components that would directly increase their costs, especially for their crucial U.S. build-out?
Okay, so we've covered the business, the management, the money, the market view, and the risks. Let's try to pull it all together now in Chapter 7. Conclusion.
So the bull case is really compelling. You've got a pure-play AI infrastructure company led by a proven founder with a rock-solid balance sheet, incredible strategic partnerships with Microsoft and NVIDIA, and what looks like a real technical edge from that inherited Yandex talent.
But the bear case is just as stark. You've got immense execution risk trying to scale so fast against giants. The valuation is already pricing in a huge amount of success, leaving very little margin for error. They're reliant on external capital markets to fund the burn, and they're incredibly vulnerable to any supply chain issues, especially with NVIDIA.
Right, so bringing it back to the current price, $123.82. That sits pretty much right in the middle of our estimated intrinsic value range of $110 to $145. What that tells us is the market is already quite optimistic. It's pricing in a successful execution of their plan. For someone looking to invest today, there isn't really a significant margin of safety at this price. You're essentially paying for the success they work to achieve.
Which leads us to our final thought for you to chew on. That dual-class share structure we talked about, it gives the CEO incredible freedom to pursue this long-term vision, shielded from quarterly market demands. But is that strategic shield ultimately the key to dominating the market? Or does insulating management so thoroughly from immediate accountability maybe become a hidden long-term risk for shareholders if things go off track? Something to consider.
And please remember, this analysis was generated using an AI research protocol. It's purely for educational purposes. It is not financial advice. You absolutely must do your own research and make your own decisions.
Exactly. We really hope this deep dive into Nebius Group was useful for you. Don't forget to like and subscribe to Stock Analytics AI. And remember, members can request deep dives on specific stocks. Just drop the ticker in the comments and we'll get on it. Thanks for joining us, and we'll catch you next time.